The Icons of Real Estate Podcast. Are you ready to learn the proven money-making secrets from top-producing Icon agents? Ready to skyrocket your business? This podcast is for you. Tune in every week with your host, Tomasz Fonseca, and find out how to implement proven strategies to 10 times your business, from $3 million to $30 million in just 12 months. Brought to you by the Masters at Real Estate Marketing, Ardor SEO.
Welcome to the Icons of Real Estate podcast. I'm your host, Patty Teal. Today's guest is Kyle Jones. Kyle is a full-time entrepreneur and multifamily real estate investor. He's the president of TruePoint Capital, which offers closed-end private equity funds in the private real estate market. They're focused on ground-up construction. Welcome, Kyle.
Hi, thanks for having me. Just happy to be here.
Oh, it's so great to have you. And now you're located in Texas, is that correct?
I am. Houston, to be exact.
Houston, to be more exact. Great. So, Kyle, would you mind kind of telling our listeners how you got to where you are today, to this type of success, where you started and how the trail took you here?
Yeah, I think it just, there were a lot of things, but I think that at the high level, it was just really just a matter of me jumping in and taking action. I when I first started investing in real estate, I didn't really have a goal of ending up in the multifamily side, and especially on the development side. That's kind of how we've organically evolved. But it really started with me looking for a way to just create some additional skills that I had that I didn't have while I was working a W-2 job. So creating a path to make additional income for me and my family. And so, just started out with single family properties. And eventually, as we continued to grow and continue to buy more single family properties and have since sold most of them off, we actually still have a couple that we own just that are easy rental properties for us. I realized that as I was proving the concept out to myself that this actually works, and how can I do this on a bigger scale, or, just as an example, one of the questions that I was asking myself. And so that ultimately led me to continue to do some research and studying, and obviously brought me to multifamily with just being in the residential real estate already. And, through that, we just started buying some smaller multifamilies and continue to grow from there through partnering up with other people who have already done this before. And then eventually getting to the point with what we're really doing now, which is raising capital. And that's what the bio, the feel good bio that you had is really just a matter of what we offer our investors in raising private capital through syndication, where we bring on investors and go buy much larger real estate. So that's kind of how we evolved to get there. And, obviously there was a lot of nuances in that, a lot of different education things that we needed to go through. So, but at a high level, that's kind of how we ended up here.
Well, that's very cool. So it must be very exciting now that you're actually building from the ground up, to be watching every part of a project as it grows. So take me through the steps of how that would work. Would you find the property, work with an architect? How does it work? Find the investor? What's the order of things?
Yeah, I think for us, it was, we had somewhat of a proven track record with our investors of, generating returns for them. So we already kind of had built up some trust with buying existing buildings in the B class, mostly, in some C class space for the value add side. And so as we started looking to potentially move into development, we knew we didn't have that expertise, my partner and I, that is. And so we actually went out and found another partner who could be on the general partnership side with us, who has been in the project management side and leading a full ground up construction project. And so I actually had a mutual connection with our partner now, who introduced us and essentially brought him into our partnership for the ground up construction side. So he carries 25 years of experience in multifamily, and not just multifamily, really all things commercial office space. He's done some very expensive projects, much more than what we're even doing right now. So he carried some really good experience, and also knew how to manage budget very well. So he's the one that we really relied on in walking us through the steps of what that development looks like. So, once we actually ended up going after a piece of land, that's where we pull in some of the other experts that you mentioned, like the architect, the contractor. A good civil engineer is somebody that's really a strong skill set that you really need to navigate the ins and outs of the city municipalities, all the zoning, all those types of things that they typically handle on the front end. But you really need, those three resources for sure going into a project ahead of time, having them identified at least to give you an idea on what is this thing going to cost, let alone is this a good deal? What's it going to cost to construct this project? And so, and having a good architect, a good contractor, and a good civil engineer can kind of help you piece that together.
It sounds really exciting, kind of like birthing a baby, you just watch it grow there. That's very cool. Now, do you stick pretty much to investments in the Houston area?
No, actually, we've invested all throughout the Southeast. We do have a large chunk of our portfolio here, but we also have a large chunk of our portfolio in the Sun Belt. So, we just sold some properties that we owned in Mississippi. We have owned in Tennessee. We still own and operate in Alabama. And so we really like the Southeast part of the US in the warmer climates, and just really where a lot of the growth patterns are happening.
And the people who invest in your projects, do they range from smaller investors to larger investors? What would be the cost range? What would be the minimum they need to be a part of a project? And I suppose the maximum, if there is one.
Yeah. We have not had anybody reach the maximum. I mean, we have had some large investors come in and want to do some large chunks. But I think the average investor will bring in anywhere from 100 to 150,000. Our minimums are generally in the $50,000 to $60,000 range. But we've just found that we've seen a lot of our investors just come in at least in the 100K range. So, and all types of shapes and sizes and backgrounds and experiences. We have some brand new folks who this is their first time ever investing passively, to people who have invested in multiple deals, and even have some investors who have invested in pretty much every deal that we've put out. So it really just, it varies big time, and it just kind of depends on, how you're starting out and how you establish your network of investors, and then just kind of how it grows from there.
That makes sense. So is this an especially good time to invest in multifamily?
I think so. I think it's, we're sitting in the middle of a high interest rate climate right now. And it feels like there's a lot of volatility, which there really is. I think, you really have got to make sure before buying anything in this climate that it carries the right characteristics, and it's in a strong location with good continued job growth and population growth. People who can actually continue to pay rent. That's what we need. So, and then buying at the right price. We've seen the debt markets kind of pull back on how much they're willing to put in terms of loan dollars. And that has obviously brought pricing down a little bit as well. And it's also really pushed out a lot of your competition. And so if somebody comes across a good deal in a good location and has true comparable rent growth characteristics to it, and I say true growth, like you've got to really make sure that, hey, if I renovate this property, if I take this on, we're going to be able to cash flow, and we're going to be able to raise rents even in a high interest rate environment. So you got to make sure that you're buying it at a right price. So now naturally that has caused us to slow down our acquisitions just a little bit, just because there are still a lot of very optimistic sellers out there who think they can get top dollar even in this
Oh,
type of climate, which is just
mhm,
not the case.
right.
Um, but we've been very strategic in what we're looking for, and which is really what pushed us to focus pretty much 100% on the land side. We're not 100%. I would say 90% focus is just on the land side right now, because we feel like by the time you acquire a piece of land to develop, by the time you actually break ground, it's at least 12 months, maybe even
Mhm,
18 months before
mhm,
you do that. So, in 12 months, we're going to be in a completely different market. Hopefully it's softened from the volatility side, and kind of just got back to the way things were. Maybe not the way things were, but maybe the interest rates have come down a little bit. But either way, we're watching that, and buying land gives us that freedom to kind of sit back and wait. And the term is called land bank. So we buy the land, and if we want to move forward, we can, or if we want to hold it, we can hold it for a couple of years.
Oh, I didn't know that term, but yeah, that would be a useful thing to be able to wait until the timing is right.
That's right. That's
Mhm,
right.
yeah. Now, your website mentions alternative investments. What would that be?
Yeah, it's really just alternative in terms of just outside the norm of the stocks and the bonds and the
I
mutual
see.
funds.
Mhm,
So alternative is mostly what we do is real estate. It's all real estate
mhm.
related. We don't do any crypto or anything like that. And we just kind of stay in our lane in terms of real estate related types of projects. And so most of that is multifamily. We have looked at mixed use type developments and things like that, and I think there's more of that to come in the future. But right now, most of it has just been primarily multifamily in just different shapes and sizes, just strictly on the multifamily side.
Right, right. So how important do you think it is for your investors to diversify?
Um, I tend to take a little bit of a contrarian approach to the notion of, hey, we've got to diversify. I
Mhm,
think it depends on what you're already invested in, on whether or not you need to diversify. So it's really a relative question to the specific individual. But I think if somebody is heavily invested in like a real estate, or something that has a physical component to it, like a physical asset, that's really where I think these next few months, maybe even couple years, is really going to shield investors from huge market swings like they might experience in terms of losses in the stocks.
sure.
I frankly feel like we haven't hit the bottom. I'm not the type to push out any kind of projections or predictions, but I think what feels good to me is owning something that has a physical nature component, and knowing that, and like if we just look at real estate, the trajectory is just a gradual increase in terms of value, and maybe mainly driven by inflationary pricing as well. But when we come in at a good basis, and if we look to sell that property in 5 to 6 years, and we've just risen with inflation, our basis is looking pretty good when we look to exit from that. And so that's the physical component to it. Whereas, if you're just investing in the stocks and the mutual funds, you're really not even keeping up with inflation in terms of just the highs and lows and the volatility, also with a rapidly increasing rate of inflation. So, um, I think all that to be said, if you're heavily invested in real estate, there are ways you can diversify within the physically backed asset class. That's the main thing that I'm personally looking at. So that doesn't include stocks. I'm not doubling down
Right.
on stocks. I'm not looking at crypto. I'm not looking at some of these other things right now, just in the market that we're in.
Well, real estate has definitely proven itself as quite the amazing investment if you hang on to things long enough.
Absolutely. Absolutely.
Yeah.
And you have to, going into a deal, you've got to make sure that you can, that you structure the deal mainly on the debt side, that you structure it in a way that you could hold it for 5 to 10 years if you need to. The
Mm-hmm.
short-term loans is really what gets people in a lot of trouble when, the note is coming up for the balloon payment and, we're kind of in a down market. That's really what causes people to lose money in some
Mm-hmm.
cases. But if you structure the debt in a way where you can ride it out for 5 to
Mm-hmm.
10 years,
Mm-hmm.
in 10 years, I feel very confident that we're not going to be in the same market that we're in today.
Right.
And a lot of our properties are structured on loans that we could hold for essentially 10 years.
Oh, yeah, that makes perfect sense. So, how do your investors learn about you? How do you connect?
Yeah, we really we have a team of folks who are doing market outreach, trying to draw people into our funnels. But we also try to send out weekly newsletters to just get engagement and provide value that way. And just through regular touch points and communications with our existing investors, meaning property updates, we're constantly letting them know. On a monthly basis, we send out reports for the existing investments. And so we're really just trying to stay in front of them in terms of communication and engagement. And, we open ourselves up. If somebody wants to reach out to us, we make ourselves pretty available through scheduling a call. Of course, we don't, we've got a lot of investors. So if they just reached out and constantly, that would probably create a lot of chaos, but
Right.
they can schedule calls with us and talk to us
Sure.
directly if they would like to as well.
Hmm. So, for your business, what's the biggest challenge?
I think right now the biggest challenge is just staying on top of um, with collections is a big challenge right now. I think we're seeing a little bit of a softening in some of the older vintage assets where the kind of the transient tenant that I think they're it doesn't feel like COVID era, but it definitely we have seen a little bit of a drop in collections across the board, I think, just with where we're at. And so, we're doing what we can to take the measures to bring that back up. But, on a more strategic level, I think, we like to continue to grow. And so not having a property to be able to put in front of our investors feels like we've kind of slowed down. And we have investors who say, "Hey, we haven't seen anything from you guys that's new in a
Sure.
while."
Mm-hmm.
And so, we're just constantly communicating, "Hey, this is why, it's because it's market driven. It's the market that we're in." And if anybody's been paying attention to the market, everybody knows that, especially just with interest rates and the volatility there, they can kind of see what's going on. So, but that's the really more at the strategic level, because that's where I like to stay. I mean, we can figure out ways to get more collections with our property management team, but we obviously we're coming into the market. We had some growth goals, and we're going to miss those by a large number, but it's also by design
Mm-hmm.
because of just being way more cautious with the market that we're in.
Right. Yeah. So, I mean, you are involved in the property management. I mean, that's not your favorite part, but your company is involved with all of that, from the groundbreaking part of it to collecting the rent. Is that how it works?
So we hire it out. So we hire a third party property manager. So we just mostly oversee the property
I
management
see.
teams that
Mm-hmm.
we have from an asset management standpoint.
Mm-hmm. Okay. So, when you're looking at properties, is location one of the very, very most important things that you watch for?
Yes, I mean, I think that's I can tell you pretty quickly, just based on where a property is, whether or not we're going to be interested in it. And
Really? So
so,
it's that quick?
oh yeah, yeah.
Mm-hmm.
Well, I mean, mostly where we're looking is in markets that we're already in. And so we have a pretty good handle on where the good areas are, where we want to invest. And I'm not saying if we don't invest to it, it's not a good area, but just where we're at now, location's always been a focus of ours, but even now, in the volatility of the market that we're in, we're taking it to another level and being extra careful. So it's like we've taken our location criteria to another level that's very, very stringent in the markets that we're in. Houston's a big city, so we've really just narrowed in our focus where we're really not even looking unless it's in, the certain areas. And we've communicated it out to brokers, but yeah, in general, anytime, location is always a critical item for anybody to be careful and make sure that that's an area they want to invest in.
Yeah. And some of our listeners may already know this, but you said you're in the B and C class space. Can you explain what that means?
Sure. So there's really kind of two ways to classify whether or not a property is you have an A class, a B class, a C class, and you even have a D class is kind of the industry terminology. And so the B and C class are typically your older properties, anywhere from 80s. B class would probably be considered late 70s to early 80s vintage, and then the C class by vintage would be early 70s and even to the 60s. And then you have, so that's the age of the building, but you also have the location. So you have A, B, and C locations. And so, people might hear, hey, this is a C property in a B class location. Well, that means it's just an older property in a nicer area. Or you might have a B class property in an A class location, a little bit older property in a very good location. And that's typically, we like the A and B locations for sure. We're willing to take a little bit to look at a property that's a little bit older, knowing that there's going to be more cost on the maintenance side because we're having to constantly fix things.
Sure.
But if it's in a really good location, then there shouldn't be any reason why it should still continue to stay full in terms of occupancy. And so it's really just a rating, in terms of like location, A, B, and C and D class. A is a nice area. B is probably more your working class. C, I would equate it to people who are, that next step below working class. Maybe they're like service type employees or locations. And then the D class is high crime, very low income area.
Okay.
You don't want to be in the D.
No,
there's some people who make a lot of money in the D class, but talk about a headache in terms of the management side. So we steer clear of the D class locations for sure.
And I know you often go from the ground up, but when you don't and you purchase a B or a C class property, is part of your plan to remodel it and make it look better and nicer so that you can charge more rents?
That's the name of the game. It's really, I always equate it. It's no different than what you might see on like HGTV with Flip This House. It's the same concept. You just do it over the course of 5 to 6 years. So it's a longer business plan because, generally the properties that we're looking at are 150 to 250 units in size. We've got some up to 400 units in portfolio. So they just take a long time to go through and renovate all those units, or a good chunk of them, so that you can generate enough value to be able to increase the rents on those renovated units.
Yeah.
So it's really just like a long flip. If you think about it that way.
With bigger profits. Yes.
That's true.
That's true. Yeah. Well, Kyle, this has been so very interesting. If some of our listeners would like to contact you about investing or learning more about TruePoint Cap, how would they do that?
Yeah, they can just go onto our website. It's www.truepointcap.com, and there's a couple ways they can opt into the contact us, or they can opt in to start receiving our newsletter. And those are the two ways to start receiving immediate engagement. And then a member of our team will reach out and usually set up a call with me talk about investing goals if they have any interest in investing passively and things like that. But our website, they can reach out to us that way. That's the easiest way to get a hold of us.
Well, thank you so much, Kyle. It's been a pleasure to have you on Icons of Real Estate podcast. I learned so much, and I know our listeners enjoyed it. Thank
You
you.
bet. Thank you so much for having me.
Thank you.